Hey everyone and welcome back to another video for today. So Nebius reported their quarterly figures before the market opened. At the time of making this video, the stock is basically flat. But also remember, over the past couple of weeks, the stock went up over 50%. But for the quarter as a whole, numbers met expectations, guidance for the year still the same. They expect ARR to be between $750 million and $1 billion. And they still expect that to happen. I would say it's probably going to come closer to that $1 billion than to that 750 million one, which is the most important part. They also touch a little bit more on the profitability side of the business. So we're going to talk about all of that in this video. Unfortunately, the earnings call, well, I couldn't join because you have to join through a Goldman Sachs Zoom link and it was already at capacity. I don't know why they do it like that, but fine. Anyways, Nebius, I did a couple of videos about that. I think I'm the first one to actually talk about this company at the start of the year. If you want to learn more, those videos will be in the top right corner. Right now, what do? Well, they're engaging in building full stack infrastructure for global AI industry. It's a company with a market cap closer now to $9 billion. Previously, it was Yandex, the Google of Russia. They had to divest the business, basically recreate a whole new business, headquarters in Amsterdam, in the Netherlands. They operate in Europe, in the United States, going to operate in the Middle East as well. More on those locations in a second. So yeah, very, very interesting company. I own shares. I'm extremely bullish on it. So let's dive right into this. If you enjoy this type of videos, hit all the buttons, especially the subscribe one. Really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/gotchainvestor. Thank you very much. All right, so as for the headline numbers, of course, you might say, oh, this doesn't make any sense. This is a company $9 billion, but only generating $55 million in revenue. Doesn't make any sense. But remember, the annualized revenue run rate is much, much higher than that. But still, revenue did increase 385%. Adjusted EBITDA loss is improving, has improved by 12%. Net loss from continuing operation, that did increase by 41%, and adjusted net loss did increase by 19%. Now, cost of revenue increased 231%, but as a percentage of revenue, we're now down from 78% to 53%. Looking at the same thing here for total operating costs and expenses, that did increase 96% year over year, but as a percentage of revenues, that is down from 827% to 334%. Moving on to the most important parts, I'd say. So, fellow shareholders, Nebius Group had a very strong start of the year. Our core infrastructure business delivered annualized run rate revenue as of the end of Q1 of $249 million. That's up 684% year over year. Of course, these year over year comparisons are, well, don't make that much sense because when you start from a very, very small base, of course, it's going to look like this, but still impressive. We are continuing to see strong dynamics in Q2 with April ARR of approximately $310 million and have maintained this strong momentum into May. This demonstrates the strength of our business model and our ability to scale up rapidly. We are rapidly expanding our capacity footprint. In just 3 quarters, we've gone from 1 location in Finland to 5 locations across Europe, the US, and now the Middle East. We are actively exploring new sites in the United States and around the world, and we expect to provide more news on this soon. So pretty exciting. Of course, the more they expand, the more they'll be able to generate revenue. We are on track to achieve $750 million to $1 billion in annualized run rate revenue by the end of the year. And in the second half of this year, we expect Nebius Group to turn adjusted EBITDA positive. Thumbs up for that. In the medium term, our base case expectations are to achieve billions of dollars in revenue with adjusted EBIT margins in the range of 20 to 30%, assuming a conservative depreciation schedule of 4 years. So again, in the short term, whatever happens with the stock, if it goes down, me personally, I'll be adding more and more because I truly believe that this is another case of, well, a potential multi-bagger in the next 5 to 10 years. Looking ahead, we plan to fund our growth in part by tapping into our non-core businesses and equity stakes. We are not aware of any other company in our sector that can raise potentially billions of dollars in this way. The value of our minority stake in ClickHouse is substantial. We talked about that a week or two ago, right? ClickHouse, I think we're raising money to get a valuation of 6 billion or maybe even more than that. So pretty impressive, and they do own, I think, 28% of ClickHouse. They continue by saying here, we believe it is continuing to grow. Should ClickHouse have a liquidity event in the near to mid-term, this would provide us with significant capital to invest into our core business. We believe Tooka has the potential for strong future growth given its recent funding round with the high-caliber investors, including Bezos Expeditions and Michael Parakin, the CTO of Shopify. We retain a significant majority economic stake in the business. Additionally, AV-Ride is building autonomous technologies that can be strategically valuable to many companies. We are actively exploring strategic investments and partnerships to help accelerate its growth. More on those businesses in a bit. But first, a bit more on the core business. So, as of the end of Q1, we operated mostly NVIDIA H200s, with the remainder being NVIDIA H100s. As we start rolling out NVIDIA Blackwells in Q2 and NVIDIA Grace Blackwells and NVIDIA's Blackwell Ultra in the second half of 2025, we expect to significantly increase our capacity in terms of H100 power equivalent GPUs in service by the end of this year. We have significantly expanded our data center network, adding a number of new locations in addition to existing facilities in Finland and France. In Iceland, the co-location opened in March 2025. Kansas City, the co-location came online in April 2025 and is now fully operational. We will start rolling out NVIDIA B200 GPUs in Q2 2025. And then in New Jersey, they announced in March 2025, this build-to-suit facility is being constructed to our custom design specifications. Construction is well underway, and we plan to make the site's first capacity available in late summer 2025. Again, the speed is very impressive and very important. We expect that our global data center footprint will amount to approximately 100 megawatt of contracted capacity by the end of the year, and we plan to significantly grow our capacity in 2026. I also believe in a recent interview, the CEO said, look, we will grow extremely fast, and we will grow as long as there is demand. That's the important part, right? The demand. As long as there is enough demand, they will be able to grow and generate more and more revenue. Touching back on their other businesses. So AV-Ride has entered into a partnership with Hyundai to co-develop a full autonomous vehicle platform. In March, AV-Ride announced a partnership with Hyundai Motors for the co-development of a fully autonomous vehicle platform, including redundant safety systems such as steering and braking. Hyundai will handle vehicle manufacturing and assembly, enabling AV-Ride to focus on software development and system integrations. The partnership also provides a pathway for AV-Ride to scale its AV fleet, starting with the addition of 100 Ioniq vehicles in 2025 and further expansion planned in the years ahead. AV-Ride and Hyundai plan to begin testing a robotaxi service in partnership with Uber by the end of this year in Dallas. Moving internationally here, Tokyo is marking AV-Ride's first entry into Japan. AV-Ride developed its initial fleet of delivery robots in Tokyo through a partnership with Rakuten. There is strong interest from local authorities and other autonomous tech stakeholders. This reinforces Japan's long-term potential as high-quality, attractive market. As for Tooka delivered strong and consistent performance in Q1 2025, with revenue more than doubling year over year. This growth was driven by a combination of market demand and disciplined execution. All major frontier lab contracts were renewed, reaffirming Tooka's position as a trusted partner for high-impact AI data solutions. Tooka also added leading AI developers and enterprise clients to its pool. Its current customer base includes top technology companies such as Anthropic, Amazon, Microsoft, Shopify, Recraft, and others. As AI agent-based computing accelerates, Tooka is differentiated by its ability to solve some of the most technologically complex data challenges in the industry, setting it apart from other players in the AI data space. Lastly, here is TripleTen. Revenue grew 144% year over year, driven by nearly a 50% year-over-year increase in student enrollment across key markets in the United States and Latin America. TripleTen recorded its first revenue from B2B training products, a new strategic pillar that leverages TripleTen's platform capabilities. The business also enhanced its offerings to include AI-enhanced learning tools aimed at improving engagement and outcomes. Together, these developments position TripleTen's expertise to address a broader learner base and unlock new channels for growth through 2025 and beyond. So of course, while the focus is definitely on the core business, let's not forget all the other parts of Nebius Group's businesses that you get on top of it or below it. You can call it call options, you can call it whatever you want, but yeah, I don't think you have such a company in the market that's under $10 billion that is growing this fast and that gets you exposure, well, in, let's be honest, multiple industries that are, of course, fast growing. And a day or two ago, we got another upgrade here by DA Davidson. They initiated Nebius with a buy rating and a $50 price target. The company has emerged as one of the first true alternatives to hyperscale dominated AI compute, analysts at the firm wrote in a note to clients. Nebius is taking advantage of the opportunity of companies like Amazon Web Services, Azure, and Google Cloud Platform having rigid pricing and artificial supply constraint by offering dedicated AI compute, transparent pricing, and scalable infrastructure. Based on a sum of the parts valuation, the analyst said the core Nebius business is worth $6.9 billion, assuming $750 million in 2025 revenue, while the net cash brings the enterprise value to roughly $12 billion. Eventually, AI compute demand will stabilize, but for now, Nebius is structurally positioned to absorb the long-term broad AI workloads. And yes, of course, AI compute demand will, of course, eventually stabilize. But then, as Jensen has talked, then it's all about AI factories and token generation, and that's how you have a much better return on investment. And I think that's where Nebius is positioning, and of course, energy efficient solutions is going to thrive. And so, all in all, I'm pretty happy with the results. I'm pretty happy with the execution here. I'm very happy with the stock's performance, especially since I bought the shares, but I talked about this stock at the start of this year, and I think it has done quite well since. So yeah, not going to complain. It still is a small position in the portfolio, which I intend to grow over time. So that was everything you needed to know. Of course, I will update you on Sunday during the portfolio update if anything crazy has been mentioned during that earnings call. Hopefully, I'll have time and access to that transcript very soon. So that's about it for me. If you enjoy this type of videos, hit all the buttons, and I'll see you all in the next one. Bye-bye.